And the angel investing, that was the one that's probably the biggest eye opener because, you start going to your first startup pitches and, you're listening to these just exceptionally bright people. I mean, these scientific inventor types, that understand things at a level I never will, right? And they come up with some marvelous invention for some cancer curing drug or some fantastic micron sized LED deep tech or just, whatever it might be. And they're wowing you with the idea. And you're like, wow, that would be disruptive. That would change the game. That should be $1 billion idea. And you start investing in the ideas before you realize that it ain't the idea. It's not the horse, it's the jockey, it's the team, it's their experience, it's the execution, it's the business plan, it's the capital plan. It's everything but the idea that makes a startup succeed.
Welcome back to the AI Edge podcast, where we talk with operators, investors, and capital partners who are shaping the next wave of real estate and private investing. Today's guest brings a rare mix of perspectives: small business owner, fractional CEO, CFO, angel investor, LP in institutional real estate, and broad level leadership in the startup ecosystem. He is the chair of the board at Desert Angels, co-founder of Startup Ecosystem, and the owner of Open for Business, where he provides fractional CEO, CFO strategic planning for small businesses from pre-launch to exit. On top of that, he's a prolific investor across alternative assets, including angel capital and institutional real estate with LP positions across multiple state sponsors and groups. And the best part, he describes his career journey in one word: unpredictable. Jeff, welcome to the show.
Thanks for having me.
Awesome. Great to have you here. So let's start off right away. And I want to start the word unpredictable. So when people ask you, so what do you do? How do you usually answer that today, Jeff?
I putz around. I've always been into small business. I think it's, fundamental to the U.S. economy and to our American heritage. And so, I moved through different phases. And obviously, I've had my small business ownership phase. I've done advocacy in D.C. and at the state level, and then you kind of, you get to a place where you can move into the investor phase and or do consulting. And so I've just, had the opportunity to do a little of all of it for a long time.
Incredible. So your background starts in music and marketing at the University of Miami, then moves into owning and advising small businesses, and then into angel and LP investing. So if you connect the dots looking backwards, where are the big turning points that shaped your path?
I think relationships are obviously the thing that probably have the most impact on the decisions that we make, right? The people that you meet, the books that you read. In fact, I think there was a motivational speaker from the 70s that said that who you are is based on those two things: the people you meet and the books you read. But I would just say that, obviously meeting my wife in college had a big part to do with, where we continued education, where we lived, and then you meet other people. And, I did a 10-year corporate career. We jumped out, started a business, started another one, and just, kind of kept going. You didn't really know what was around the corner next or who you were going to meet. And I think it's ultimately relationships and people who you meet, and you go from a place to another place and build relationships, and, opportunities appear. Some folks are opportunists and take advantage of it. Others are very goal oriented and kind of, determine who they want to meet, what they want to do, and they're very focused on that. But I've tended to be more path oriented, just kind of see what comes next.
Beautiful. You bought and started, operated, and sold multiple small businesses. And now you've come in as a fractional CEO, CFO for others. What did those early small businesses experiences teach you about risk, capital, and what do you still use today as an investor?
Well, the funny thing about investing in anything, whether you're investing in yourself and starting a business or investing in someone else, is I think the best investors are actually risk averse. They're not crazy risk takers. They don't like losing, right? And I certainly don't like losing. And so, in my own small business pursuits, I wanted to figure out how to make it work. And I didn't come with any formal training in finance, but I recognized, fairly quickly along the way, if you don't pay attention to the numbers, you're going to get trounced. So I started paying attention to the numbers. I basically taught myself bookkeeping, then I taught myself financial planning. And because I had to translate it, to the lowest common denominator, which is me, I learned how to explain it simply to others. And so I just kind of fell into consulting after some period of years and recognized success. Others started coming to say, well, no, you seem to know how to do this. Can you help me? And I took that took me by surprise somewhat at first because, I wouldn't have considered myself a teacher, but, I say yes easily and I like to help. And so I would just get involved and say, well, show me what's going on. And patterns would just appear to me, patterns that, lead to failure, patterns that lead to success. They don't always listen, but, happy to share with folks what I think they need to do to take the next step toward profitability. And so that kind of went on. I was consulting more and more, ended up really carrying clients for almost 20 years. And, but then one day our local economic development director walked up to me and said, hey, we want to start an angel group. I said, what's that? I had no idea. Like most folks, most of my investments were in a 401k, public stocks and bonds. I had started doing real estate a little bit locally, buying a rental home or two. And he explained it to me, and it was new for the community. I said, sure, what the heck, and came into the first meeting and saw startups pitching, and everyone else was asking questions about how the solution works. I wanted to ask questions of how you're going to make money. Every idea is a good idea, but most of them are not commercializable. And so here I was surprised that nobody was asking about money. Everyone else was surprised that I was asking about the money. They were like, "Wait, you understand the finance stuff?" I said, "Wait, you don't?" Kind of found out that angel investors are subject matter experts in a big range of things, but not a lot of them really understand the finance component. So that kind of, continued to sort of be the wheelhouse, the specialty for me. And then I joined another group looking for deal flow and became experienced at startup investing and relocated, went across the country, came to this great state of Arizona. I love Tucson, and I joined the local angel group here, and one thing leads to another, and now I'm the chair of the board. So I don't know what to tell you. Things just happen.
That's amazing. For our listeners that don't know about the angel group, can you explain that?
Yeah, angel investing is a tiny slice of venture capital. So, the nuts and bolts, like I say, I have to learn everything at a very simple level. So to explain it at a simple level, if you invest in public stocks and bonds, publicly traded companies, well, where does the money for all of the other companies go? Well, that's what's called private equity, not public equity. It's like those are antonyms: public equity, private equity. So in the private equity world, then you have all kinds of different ownership structures. There's closely held stuff. There's private equity funds. There's venture capital firms, and there's angel groups, among other things. An angel group tends to invest in a startup at a very early stage before venture capital. We're usually investing either right before or while a company is getting its first sales, when it has an MVP, most minimum viable product. Unless it's life science. If it's life science that requires FDA approval, then that's a different track. And we're usually investing when they have bench data demonstrating that their solution might work, but still haven't entered into human clinical trial. So, it's high risk. You're not going to make anything on most investments. So the few that hit have to be big hits, and so we're targeting a 30x return on the ones that hit. We're very, very happy if we can get to a 10x return. And so, there's a lot of due diligence involved. You do a lot of investigating. And you work with others. Angel groups are groups of individual investors who all make their own investing decisions, but we work together on the due diligence.
Amazing. So how do you evaluate a company? For example, my business partner and I have a business partner who lives in Miami, and we planned on, which we still haven't launched, but we planned on creating our own e-commerce shoe brand for men's shoes, comfortable, breathable, where most men's shoes, dress shoes, or, that. He flew out to India, where we decided we were going to manufacture with real leather and have a good product. So my question to you is, how do you evaluate these companies without having any sales? It's just an idea, right?
Yeah.
So what do you do in order to invest in these type of companies?
Well, this used to be a totally unknown asset class prior to, the 1990s. And so it's really relatively newly popularized. And the biggest challenge we have in evaluating a company that would like funding from us is determining, is it really venture backable, or is it a lifestyle company? And a lifestyle company is 95% of starts every year. We produce a million new EIN numbers every year in this country. A lot of people want to start something, but most of them really aren't venture backable. Venture capital looks for startups that can scale very fast on a huge geographical level and are likely to be quickly acquired by a strategic bigger player, or maybe even IPO, go on the stock market. That is not going to be your local restaurant. That is not going to be most of your consumer product, new startup brands. It usually requires a genuinely new innovative technology, something that's patentable. It's going to require a lot of capital by definition. It's not something that's easy to bankroll for one or two people. It's a race to the market, where you have to gobble up market share that somebody else is going to be willing to buy. And so it takes, there's a lot of first time CEOs that try it, but the failure rate is even higher. You usually will have wanted to have been an apprentice under an experienced startup CEO who's produced exits before, and
Yeah.
kind of, learn before are a startup CEO yourself in a venture backed business. So, 50,000 or fewer of these startups every year will gain any kind of arm's length outside investment capital. And most of those will not make it. Most of those will fail. It's a very challenging environment for capital.
Sounds pretty risky in order to invest in a company where it doesn't have any balance sheet, right? There's
Yeah,
no
it
no
is. It
revenue.
is. And we understand that. We expect that. That's why you have to be committed to not just investing in a company or two. You need to invest in 15 or 25 very slowly over, a 5 year or longer period, and have a 20-year horizon for seeing those actually fully cycle. So it takes a lot of commitment. It takes its time. It takes its work. And you don't do this with a significant amount of your wealth. You should not invest more than 10% of your investable capital into startups. Most of your investments should be in public securities and or real estate as the best hedge.
Understood. So how does somebody like my business partner and I be able to qualify or be able to be evaluated by the angel group or angel capital?
Well, you'd have to be able to demonstrate that you've actually invented something that would be very difficult for anyone else to invent or duplicate. If it's just basically a style thing, like, oh, we're going to shape the shoe different, or we're going to have cooler colors, or, something like that. If you're basically using off the shelf technology, that's not going to really be where venture plays. Now, that doesn't mean that you can't build a great business or a very profitable business or even a multi-million dollar business, because you can, but it might be slower. You might be relying more on traditional capital like institutional lending, or you might need to just raise more capital in the private equity space from friends and family and people that are willing to believe in your vision.
Excellent. That's fantastic. I appreciate that, Jeff. So when you step into a business as a fractional CEO or CFO, what's the first two or three things that you look at to understand if this thing is actually healthy?
Well, any business, doesn't matter whether it's venture backed, closely held public, any business has to have a solution market fit. There's a lot of people who know how to make a thing, and they might know how to make it really, really well, and it might even have some uniqueness to it. But that doesn't mean that the market necessarily wants to buy it in great quantity. And when I speak on stages, I like to use the example of a scuffless baseball. If you could invent a baseball that you could smack with a bat 1,000 times and it still looks new, well, that would be quite the technological achievement in material science. But who wants to pay the extra for that? Why is it important? Why does it matter? Right. And so, a lot of budding entrepreneurs get trapped in something because they think, ooh, I figured out how to do something really cool. But they don't really have a solid grasp on who's willing to part with their money to have it. And that takes, a lot of background market research. You should have some research that demonstrates that there is a willing demand for what you want to sell. And so, we start there. Do you have solution market fit? And can you demonstrate that or prove that? Even theoretically, if you're pre-launch, have you done the homework? presuming that you have viable solution market fit, then, everything else in business comes down to the financial plan, to the capital plan. You're going to have to spend more money than comes in for a good while before you have more money coming in than you're spending. And most businesses fail because they're undercapitalized from the start. They had no idea how much cash it was going to take to reach break even. And so they ran out on the way. And by the time your back's against the wall and you're running out of cash, it's too late. It's too late to correct that by that point. Solid planning foresees the risks and the potential pits ahead of you and has already planned a way around them before you're tipping over the edge into that blackness. So most people don't know how to do that, especially if they've never operated a going concern before. And there aren't enough people out there showing the way who've done it before and who are consulting. So it's a lot of people they just believe in themselves so much. They have so much enthusiasm, so much drive that they just, take the plunge, and very, very few of them by luck make it through. Most, it ends up being a very bad experience and they lose a home or they lose a marriage or, bad things happen. And that's not a route I want. I don't want it for me. I don't want it for anyone else. So really big on doing the planning, doing the work up front.
That's amazing, Jeff. So, how does that discipline of looking under the hood influence the way that you look at real estate deals and other alternative investments?
The ironic thing is, coming from the complexity of finance that I've had to look at, I find real estate to be painfully simple. It's like one of the simplest businesses you can understand. I mean, there's four to six areas of controllable expense, a few areas of uncontrollable expense. The financing, the debt equity combination is very easy to understand. So when you're looking at a real estate deal, you're just basically looking at competence. Do you have a team that's done this before? Does the location make sense relative to the use of the structure? Is it growing? People in that area paying their bills? Is there, unabsorbed demand? Do their debt terms make sense? Or, if interest rates skyrocket, are they going to get kicked in the pants? Uh, to me, if you looked at real estate deals before, you ought to know within about 30 minutes whether you're looking at a good offer.
No, I agree 100%. I'm an investor myself. Like you said, I think it's probably one of the most, simplest, I suppose, to evaluate, even to underwrite a commercial property. A lot of us who have done it long enough can look just by looking at the cap rate, the NOI, and a few other expenses and know whether or not it's a good deal or not. But I would imagine for other venture capitalists or other assets, other investments, other business opportunities, not as simple as that.
God, no, that's days and days of analysis. I mean, you got to look under every rock, and every business is unique. There's many different kinds of industries. They operate in different ways. You need a lot more industry specific subject matter expertise. That's why it's very hard for a singular angel to operate alone. We need groups of us that have different sets of expertise to work together on analyzing.
Excellent. So you now invest in cross multiple alternative asset classes, angel deals, CRE, LP positions, various funds. What was the entry point into institutional real estate as an LP? And was there a moment of a deal that just pulled you in?
That's another just, funny relationship story. You know, Social media comes online, LinkedIn comes online. I really kind of, rejected most social media. I could sense it wasn't going to generally lead to good things. So I've never really had much of a social media profile, but I did do the LinkedIn thing because that's basically the electronic replacement of the business card that we all used to, go price shop for $80, $100. And so I had a LinkedIn profile and, I had, I guess my consulting and business ownership experience out there. And I had a young man from Chicago who was an ex-pro sports player that was getting his start as a promoter who just messages me on LinkedIn and says, "Hey, would you be invested in invest or interested in commercial real estate?" And at first you get these cold reach outs from LinkedIn. And the first thing is this a scam? Who is this person? Why should I listen to them? But I was willing to take 2 minutes to follow a link and looked at a website, looked at a podcast actually that he created talking about, his values, why he's doing this, who he's doing it with. And I was able to get past that this person was for real and that they weren't, shyster. And so reached out, had a meeting, learned more, and thought, well, this model seems a lot easier than doing what I was doing, where I would buy a rental home or two and had to, get called with maintenance calls or, find a new tenant from time to time. So I started following this promoter who had a couple of GPs that he was repping for, started doing a few deals, realized that there was a pretty simple bell curve, simple pattern here to watch for. Started then reaching out and getting involved with some other promoters and following some other GPs. And so it was just another one thing led to another story. And before long, gosh, I was in 16,000 doors across, I don't know, 8 or 9 states.
Wow, it's
And,
amazing.
yeah, and brought some friends and created an LLC so they could invest with me, and just kind of started with a relationship, somebody willing to reach out to somebody else and have a conversation.
Incredible. 16,000 doors. Do you still invest in multifamily?
Yeah, it's obviously been slow lately. The exits have been on pause for a while, but yeah, closing this week, and so there's certainly a bottom somewhere around where we're at in the market. Probably a good time to be buying again. So yeah, I'm still doing it.
Amazing. What about the LP role specifically appealed to you versus trying to become a GP or an operator yourself?
Well, having owned and operated small businesses, various kinds of things, I wasn't really looking to have another 60-hour a week job.
Right.
I liked my flexibility I had found in my time, later in career. And so, yeah, it's nice as an LP that you're not guaranteeing debt. You're providing capital, help to build a trust relationship with the GP that you think knows what they're doing. Let them prove it to you before you do very much with them. So, it doesn't take a lot of time, right? I mean, you spend, I don't know, 30 minutes or an hour making your decision. You spend a few minutes making the investment, a few minutes a month reading a newsletter or a report. Occasionally, I might have a piece of advice or a question to ask that I send in. And sometimes I'm a little hard on GPs and said, hey, I don't like what I'm seeing here in these financial reports, and I think this is addressable. Can you do A, B, or C? And they're generally pretty responsive. In fact, I have one GP right now that I just kind of rattled and said, look, you guys are in a submarket that's got 12% vacancies. You're all, and I know your other GPs you're competing with because I'm in their stuff too. So, what are you doing to stand out? How are you going to be distinct rather than just saying room for rent? And I've actually taken them on a rather involved exercise of trying to imagine how they can think way outside the box, do something very different, that gives people a destination experience and reason to choose them over, the cookie cutter commoditized. It's just another apartment for another price. So, I've leveraged my consulting experience just to do better as an LP by helping my GPs be better, and I'm not even getting paid for it unless they succeed.
That's awesome. When you're looking at a new real estate deal, Jeff, or an offering today, what do you look at first?
Let's see. Well, probably the very first thing I look at is what is the time horizon and expected IRR? And, is that within the bell curve, of expectation? And then, and probably the very next thing I consider is absolutely the city. Where is this? I'm fairly familiar with population demographics, trends, where people are moving, where people are leaving, where the economy is good, where the economy is bad. So obviously looking, for things where people are coming in and not running away from. And then you start looking at the submarket local demographics, jobs, availability of services, entertainment and recreation. But ultimately, you got to study the financial model. I keep a workbook that I plug the data into that compares a given deal's financial plan to all the other financial plans I've ever invested in. And the interesting thing about doing comparative analysis is you find where there are data points that are aberrant from the others. And that could be a good aberration, that could be a bad aberration, but it could help either sell or steer you away from a deal. A lot of people don't do that. They don't get deep in the numbers, they get into the story, and the numbers will tell its own story. People that don't do the financial analysis will miss.
Numbers don't lie. Numbers tell the
Mhm.
whole story, right? That's wonderful. As far as markets, I know you're in a various amount of markets, right? Do you have some insight for our listeners on some of the up and coming markets or some of the markets you feel like are very, very hot at the moment?
And, what's the old adage in real estate. It's also the same. They use the same phrase in business. It's local, 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 right? Yes, the smile states get a lot of press because people are leaving the coasts or the north and they're coming to the south. Well, why is that? Well, that can be high tax regimes, that can be crime, that can be job opportunities, educational opportunities. For whatever reason, people migrate. So you generally want to have some kind of handle on where they're migrating to and where they're leaving, right? There was a deal that came across my desk in Chicago, and I immediately just went, Chicago.
Mm,
I mean, all I
yeah,
see in the news about Chicago is, the next crime wave, right? I mean, Chicago's got a problem to solve before I'm interested in owning real estate there. So, for any Chicago government people that just think that, we don't pay attention out here in the country or they're insulated. No, we pay attention. I'm not investing in your city. I have tended to avoid large cities in New England. I've avoided California. Now, that's not to say that there aren't submarkets within any of these places. It could be an exurb. It could be, something not residential. It could be industrial or medical office, self storage. In any of those types of property, and so there's a different story to tell about any of those. You might find yourself in the middle of Arkansas or Mississippi investing in self storage just because they didn't have enough.
right.
So why not? Right?
Huge
The absorption
opportunity.
rates, yeah, are much better there than they are in Dallas. But, Dallas is after a huge building boom here that kind of slowed things down. Dallas still has 1 million people moving in the next 10 years. They need housing. So it's still a great place to invest in apartments, right? So, what is the kind of structure you're investing in? What is the supply of that structure in the submarket? You know, if there's a demand and the pricing is good, yeah, why not?
Excellent. Do you invest locally? I know you said you're in Arizona. Are you in Phoenix or close by?
I'm in a handful of deals in Phoenix, but actually nothing in Tucson.
No, nothing in Tucson?
Tucson, yeah, there's not. I mean, it's a large enough place, but it seems like all the real estate in Tucson is pretty locally controlled. And I just haven't run around in local Tucson CRE circles. I've got these promoters in 20 other states. It's just where I happen to be.
Interesting. I know Phoenix is a super hot market right now, so
Yeah,
a lot of people investing in Phoenix. But I'm over in New England. You said New England's a no-go, huh? I
I
don't
have
invest in
one in
New England.
Connecticut. I have
Do
one
you?
in
I live.
Connecticut.
I'm actually, we're in Connecticut. That's where Edge Partners is originally from.
Oh, that's a good question. I know it's near to college and research, medical research centers. And what was
Yukon, Yale.
attractive,
No,
this
no,
is the problem. When you're in enough deals, you lose
it
track
was
of the
trackable.
details. But I mean, I know it's with Colony Hills Capital, and they had a deal where they got a loan. I think it might have been an assumed loan at a really low fixed interest rate. And so
Interesting.
here they had a business plan built in for them with a history of high occupancy that was a core plus that was going to work. Yeah, initially, New England, I'm like, yeah, not necessarily, but they were able to show me that, you know, as a specific deal, it was a good deal. And so I said, sure, why not?
Excellent. What do you think about storage asset class? Favored for it?
I always keep, it's diversification, right? I mean, they
Of
say the
course.
same thing in stocks and bonds. Angel groups used to be silly. They all used to be about investing only in local businesses or primarily local businesses. And I started looking at my fellow angel investors and they said, if you went to your wealth manager and said, I only want to buy public stocks in Arizona companies, what kind of a reaction would you expect to get?
Ridiculous.
They laugh at you, right? That's not diversified. Okay. As angel investors, we should diversify too. Invest in many industries, invest in many geographical locations. And so the same thing is true in real estate. Invest in many cities, invest through, multiple GPs, invest in multiple different types of real estate because they're hedges to one another, you know? Well, don't invest in too much office or retail. You got to be really careful in those two, right?
Not anymore. Not anymore, Jeff.
Hospitality is even really kind of tricky. But, what are people always going to need? They always need a place to live. They don't always need a hotel,
That's
right?
true. Yeah.
As it turns out, they don't always need an office because we got stuff like what we're using right now,
There we
technology to
go.
work remotely, right?
Absolutely.
So I think self-storage has been a strong, consistent asset class, even in recessions. Medical office and certain types of retirement communities because of the baby boomer en masse retirement right now.
Hmm.
Plenty of market demand. Industrial, because it had been underbuilt, right? Light industrial. There's always small businesses that need that. So those have been my favorites.
Those are fantastic. Those are great asset classes. I agree on office buildings. Office buildings are definitely ghost towns, or they're literally empty. We're repurposing them with different things, right? Whether it be multifamily apartment buildings, or I mean, some other way. But yeah, even malls, right? We have a local mall right here that's literally a ghost town. I remember, ages me now, right? Back in the 80s when when this mall was booming. It was so beautiful. It was hustling, bustling. You couldn't get a parking space. Now it's an absolute ghost town, and it's the saddest thing to see. But
And we
that's
were all thinner. Funny how that worked,
we
right?
were.
We were walking.
That's fantastic, Jeff. Jeff, what's something that you didn't pay enough attention to in the early part that you would never overlook today?
Well, like I said, I've been pretty risk averse, so I have tended to not be a leading indicator. I tend to kind of figure out where the mistakes are that others are making first, and then not duplicate them. Right? I mean, I've seen, I've read the books, of somebody saying, "Well, you can't really succeed till you fail," and they seem to glorify magnificent failures as their learning track. I'm like, well, that's kind of dumb. Would you magnificently fail at building a passenger plane until you succeed? I don't like this model to learning. So I've never actually had a business fail. I've had a few real estate deals fail, but I've been careful in spreading it around. So that all washes out. I don't care. But in angel investing, that was the one that probably the biggest eye opener because you start going to your first startup pitches and you're listening to these just exceptionally bright people. I mean, these scientific inventor types, that understand things at a level I never will, right? And they come up with some marvelous invention for some cancer curing drug or some fantastic micron sized LED deep tech or just, whatever it might be. And they're wowing you with the idea. And you're like, wow, that would be disruptive. That would change the game. That should be $1 billion idea. And you start investing in the ideas before you realize that it ain't the idea. It's not the horse, it's the jockey, it's the team, it's their experience, it's the execution, it's the business plan, it's the capital plan. It's everything but the idea that makes a startup succeed. So I lost it, a couple up front until I started looking at the right metrics. And so I'm pretty happy with my portfolio today. I think there's going to be a lot of winners in there because I looked for experienced business teams. I looked for solid, well vetted plans, business plans, and I kind of just shoved the idea aside. As long as it helped the world and didn't hurt it, I didn't care what the idea was.
That's amazing. You sit on the LP side, you read decks, you get on webinars, you experience the follow up and the reporting. From your vantage point, Jeff, what are the biggest mistakes GPs make that cause LPs to lose interest or lose trust?
There's actually a big and really timely one right now that has me frustrated with some GPs. It used to be that, if the business plan didn't work out and you needed more capital from the investors and you did a capital call, if the terms were real simple, put in your money or you get washed out. And that's how it should be, right? That's how it needs to be. And, back in the day, LPs understood that, right? They didn't fail to have cash in reserve to make sure that their projects, were sufficiently funded. Lately, with the popularization of this kind of investing and a whole lot of people who had COVID money or, had family money but really weren't that sophisticated, they started jumping into this asset class and buying up units as LPs. Well, as soon as some deals started struggling and their capital calls were needed, a lot of this younger class of GPs they didn't want to lose a single investor. They wanted to be friends with everyone. They wanted to have a gentle touch. And so they tried to come up with 6 ways from Sundays of having some creative way of doing a capital call, but not really making it hurt if you didn't participate. So 60% of the LPs wouldn't pony up. And the rest of us who are like, and then it was putting the deals at risk. And the rest of us are sitting there going, hold on, we're willing to fund this. Give us their equity. Well, they weren't ready for that. They didn't write their operating agreements for that, or they weren't willing to go get the votes for that. And I've been harping on GPs. Say, guys, look, there's a shaking out that needs to happen here. Not everybody that's got the ability to write a check should be in this business. When it's time for a capital call, just do it and make sure that everybody who doesn't participate gets diluted out and we get their equity. And then you won't have any trouble. You'll get the equity you need. We'll finish the business plan and it'll all be fine. So I think GPs need to get back to old-fashioned fundamentals.
Amazing. In our original conversation with our team, we talked about creative financing strategies for commercial real estate in 2025. From LP's perspective, what are some structures or approaches that you find attractive right now? Which ones make you nervous?
I don't know. I follow some equity crowdfunding in real estate too. And it's like, now all of a sudden they're all going out getting their circular sevens and licenses, and they're starting to try to, offer like private equity funds and compete with startup equity crowdfunding and offer like small business deals. I'm like, what are you guys doing? You're real estate. Stay in your lane. If you want to start an angel group, then different brands, start something else, put different management in on it, right? Why are you trying to all of a sudden become like some kind of capital firm that's in everything? So, I'm afraid that all of these ways of trying to expand into other unrelated asset classes is just going to defocus them, spread resources too thin. They're going to start being good at nothing, because they're trying to do everything. So, that concerns me somewhat. We have seen, a lot of typical bread and butter, high density residential real estate start to introduce the idea of having the class A that's for, cash distributions and class B that's for equity upside. We saw that kind of coming in the market. And then we started seeing distributions decline. 8% used to be what everybody offered, 80 till, and then 80/20 to, 16 IR or something. And those began to slip. Money is like anything else. It's a supply and demand market. So the more supply there is, and the cheaper it's going to be until, it's not in high supply, and then you have to pay more for it again. So I get that. It's a fluid marketplace. I'm fine with that. But I think when somebody makes a deal too complex, too many classes of investors, we got the institutional, and then we have the mezzanine investor, and you don't know who they are, and we're never going to introduce you. And then we have class A, B, C, D, and I. And, they're just trying to make too many options for too many investors, and it gets really convoluted. It also makes the PPMs difficult to understand what's going to happen if the going gets tough, who's in control, who's doing what. I think you still got to try to keep it as simple as you can.
Absolutely. Jeff, a little bit about your investing. What are some signals that someone is truly investable versus just a great storyteller?
Well, if you do your background checks, you can get a beat on that. My company, Startup Ecosystem, has actually created a tool called Team DNA. We've aimed it at the venture capital marketplace for assessing teams and boards, for having the right traits for success and being able to work together with one another. We haven't really tried to apply that to real estate, but it might apply, because what it really does is assesses management team, regardless of the business endeavor. So I do use that tool. I think it finished the work of about 70 years of academic research, beginning with Rausch and Fries in the 50s, where they were trying to study and see if they could determine predictive entrepreneurial traits, but nobody really finished the work to the degree that we did. So we're using that. But I think, a lot of time there are people that are really good presenters. There are people who aren't. I try not to let the book be judged by the cover. It has more, I think, to do with, are they conflicting themselves internally? Do they say something and 5 minutes later say something that's a little bit different or conflicting? And then, you probably are dealing with somebody who's making it up as they go, right? They're overselling it. And that's usually the time to start backing away, when either the data they show you in a deck or the words that they use are not consistent.
Amazing. Let's talk a little bit about AI. Are you using any type of AI systems right now? And what do you think the future is for angel capital or any of your businesses with AI?
Yeah, AI is obviously, and especially as a startup investor, one of the most interesting things that has come along here in recent years. And, I still don't believe that AI really exists. I just think that it's data, really, really deep and wide data mining by really, really fast processors. I don't know that real AI will ever exist, but I know there are certainly some big believers out there. I just think there's something to the human chemical brain and intuition that you can teach a computer to imitate that almost looks like it, but it's never going to replace the human being. So AI, I think, is not going to be writ large become, Wall-E, that old movie where we're all just going to become cyborgs. I think AI will succeed where it is very laser narrowly targeted to solving for a certain specific duplicative repeated work patterns, right? So obviously one of the first applications, take a paper and make it grammatically better and flow better. Okay, yeah, that's something AI can do well. Substitute for writing skill. Great, fine, no problem. I was just sitting down actually at lunch today with one of the oldest, largest Tucson commercial real estate guys, and he's using AI, and he's like, AI is going to replace CoStar. Because what is CoStar? It's a data aggregator. Well, what
It
can
is.
AI do? Aggregate data, right?
Sure.
And what little CoStar might have done that actually took human intuition, like making predictions of interest rate trends, which they haven't been very good at lately, is all that's going to be left for them. And if they're not very good at it, well, then no one's going to listen. So it is going to be somewhat disruptive for certain types of data repetitive businesses. We use it at Desert Angels to do some kinds of research, like who are the competitors, to this business. It's way faster at finding those than we used to be able to through generic search, right? Right. But from all these examples, laser focused, very, very specific applications, right? I don't think it's just going to take over. And so, that doesn't bother me. We've had lots of innovation from the printing press to the radio to the television where, okay, it was disruptive, but it was applied where it was useful and we all adapted, right? So, yeah, co-star watch out, but, for the rest of us, take advantage of it.
CoStar might be gone. Anything digital is what Elon Musk said, right? Anything digital, it can do it in lightning speed rather than having to do it manually. Are you using it at all in your businesses, say for an underwriting or any type of data processing?
I'm not really using it yet, in underwriting, partly because why take away the fun part of this? I mean, right? I mean, I enjoy doing the analysis. If I'm just going to ask a computer, tell me what to invest in, well, where's the fun in that, right? I might as well just turn it over to a wealth manager and say, you take care of my real estate portfolio.
It's fun to
So,
evaluate.
so you're right. Yeah. I mean, yeah, I think the AI prognosticators kind of forget that sometimes we do stuff because we like to do it. We're not
Yeah,
always looking for it to be faster or automated or done for us. So yeah, I want to hang on to the fun stuff.
nice, awesome. If you were talking to a new LP, Jeff, who's just starting to step into private deals, what advice would you give them before they wire their first check?
Very first check. Well, I mean, if it's me and I've done this before, don't do this by yourself unless you already have a really deep background somehow that lends itself well to this. If real estate is new to you or finance is new to you or business analysis is new to you, do it with somebody who's done it before. Apprentice, watch,
Great.
learn, The friends that I bought into this didn't necessarily have the backgrounds to do it by themselves. So, we get on a Zoom call and we open a deck and we go through it together and we talk about it, and that creates cross learning. I think a lot of industry has lost the power of apprenticeship and mentorship because it's trusted computers too much. Well, go learn online. Go search the internet. It's free.
Go look on,
Yeah, but
go.
yeah, watch YouTube. And yeah, I mean, at least YouTube ostensibly is a human being, but it's still one to many and it's not easy to ask questions and interact, right? I hate chatbots. Utterly hate them. I hate anybody that puts a chatbot in front of me for customer service because invariably it knows how to answer, some 8 or 9 stock questions. And when you start throwing in anything, a little bit outside of the norm, it's done. It's lost. It can't help, right? And how much time have I wasted trying to get through that gate before I can get to a human being who can much more quickly understand my problem and
Probably 10
solve it for
minutes.
me? right? Right. Well, AI is the same, can be the same way, or use of computer data can be the same way. So learn from humans, apprentice and master, and then become a master yourself that can teach others.
I think that's some of the best time and money and effort I ever spent was to get mentors and coaches. That's always helped to curve the learning curve, right? Really. The best thing I've ever been told was my first mentor. He said, I said, so what are you going to teach me? He goes, the best thing I can ever teach you is what not to do, because I've already done it, right? I've already made the mistakes. If I can teach you not to make the mistakes I made, which took me 5, 6, 7, 10 years, it would help you more than anything else. I thought that was great
See,
advice. I'll never
that's a
forget.
person who could have benefited from having more mentorship themselves, right? But they had to be, they had to be the trailblazer. They had to figure out
Take
how
the
to
arrows.
clear the weeds. So now they're offering to teach you. That is someone you want to learn from, somebody that's had to clear the weeds
Yeah,
themselves.
absolutely. Took the arrows in the back, right? Awesome. If you were talking to a GP who generally wants to be an LP friendly and build long-term trust, what would you tell them to focus on over the next 12 months?
A lot of GPs got caught up with volume, and some of them were out there buying a dozen deals a year, and it became such a mill that they really weren't building relationships with their investors. They had 1,000 of them, and if you put a name in front of them, they wouldn't even recognize it. That was one of their investors. And I understand, there's business efficiencies that you have to build, but I think that you can build a good relationship with investors, even if you have a lot of them, even if you're a high volume shop, simply by being willing to invest in, regular communication, a newsletter or rich reports about, a project for the investors in that project. Do more than just give them the data. Tell the story, tell the narrative. What are you talking about in the boardroom about that project? What are you working on? What could you even maybe use a piece of advice on that maybe one of your investors could help you with? That kind of transparency, openness, humility, telling them what's really going on, not hiding from them, that builds trust, right? If you're always only saying the good news, or you're being parsimonious with information and barely communicating, you're going to start to lose trust, because people are going to start to wonder what you're hiding. And your excuse might be, well, it's just, I'm too busy. It's too much. I can't keep up. I'm, working 12-hour days, and yeah, I can't write this newsletter. Well, okay. But if you're doing this successfully, you ought to be able to pay someone, right? You ought to have an investor relations manager whose only job is to think about us and communicating with us and hearing from us, and that sort of thing. So if you can't show us that we're important to you and that you want us to trust you, then we probably won't.
Amazing. Jeff, this has been awesome. For folks who want to follow your work, learn from your writing and your experience, or potentially collaborate, what's the best place to connect with you?
Yeah, I have too many email boxes, something for every platform, right? But I mean, if you're interested in angel investing, our group actually is looking for people who would like to do this. In fact, we're looking for people who haven't done it before. We're looking for people who are interested in it new. So you don't have to come with experience. You can reach me at jeff.k@desertangels. In the real estate world, or in consulting, I respond to Jeff at open4four.com.
Amazing. Do you have a LinkedIn profile, or are you on there also?
Oh yeah, I'm on LinkedIn, and I think how you go past the first part of that, and the slash and some letter, and then that's where all of our addresses really start. I think mine is just Koenig Jeff, so I don't think it's too hard to find.
Fantastic.
So yeah.
Excellent. We'll drop those links in the show notes. Jeff, thank you again for sharing your journey and giving such an honest LP and small business perspective on risk, structure, and trust. This has been the AI Edge podcast. If you got value from this episode, share it with another LP, GP, or operator who needs a clearer way to think about deals and investor relationships. We'll see you on the next episode. Thank you, Jeff.
Thank you.